And so because we've just done question number 25, which I hope you managed to review, where you're trying to work out the information there with regard to the inventory lost. We've done question 25 together, so now let's move on to question number 26, which you can see here, quite a different challenge altogether. There lies one of the problems of this sort of examination. There aren't just 3 or 4 things you need to do well. You have to do lots and lots of small exercises. In fact, question number 26 is one of the hardest for a person who hasn't prepared. But if you have, you can keep your share capital and your share premium separate and just work through it. So let's have a read together. At the 31st of December 2004, company's capital structure was as follows. The ordinary shares is 500,000 of 25 cents each, so the actual dollars is 125,000. The share premium is 100,000. In the year ended December 2005, a rights issue has been made of 1 share for every 2 held. So obviously if you've got 500,000 shares, 1 for every 2 must be 250,000. I've divided 500,000 by 2 and multiplied by 1. And it's at $1 per share. So 250,000 new shares have been issued at $1 per share, and this was taken up in full. Okay. Later in the year, the company made a bonus issue of 1 share for every 5 held using the share premium account for the purpose. So what was the capital structure of the company? So I think what you've got to do is to lay it all out, perhaps with an ordinary share capital column, a share premium column, opening balance, what has happened, closing balance, and so on. And so you come to the end of the year's figures. So quite a challenge, this particular exercise. So if you're systematic, you should be fine. So let me move on, therefore, to question number 26 as we face this issue. Nothing to it, provided you're systematic. So here we go. The question number 26. Opening balances, etc. So in dollars, we've got our, perhaps if I keep an eye on the number of ords, somewhere on the left. And then nearby we could have the ordinary share capital, the share premium. This is at the rate of 25 cents, whereas this is the extra value over and above 25 cents up to $1, whatever it might be, or and beyond. There you have it, just to start us up. The ordinary share capital appears to be $125,000. And this appears to be 100,000. So that's the opening. Just in passing, just by the way, I'm going to say these are 500,000 ords. And then you've got your rights issue, you see. Rights issue 1 for 2. Which is obviously 500,000 divided by 2 multiplied by 1. So there's the rights issue apparently 1 for every 2. So this is about 250,000 issued. Now, it's issued at the rate of $1 each. So I reckon out of that $1, 25 cents must go to share capital. So I'm going to bring in 25 cents. to share capital. So this is 250,000 odds. I could have moved that a bit to the right. The important issue, I suppose, for us is 25 cents is to go to share capital. So 250 times 25 equals 62,500. So 250,000 times 25 cents equals 62,500. And of course the other bit that is not allowed to be transferred here clearly must go to the share premium. So I'll just say this must be 25 cents. 75 cents. Beg your pardon. 75 cents. And that 75 cents multiplied by 250 must go here. And that, of course, is 187,500. So just quick mental check. 3 times 62.5 is 187.5. So that's how it's all going quite nicely, keeping an eye on the numbers of shares if possible, but more importantly, the share capital, share premium. So there you are. Not bad. And the cumulative total of the number of shares, I suppose, is something like 750,000. So the running total, cumulative total of the number of ordinary shares is 750,000. And then says question, there's a 1 for 5 bonus issue. See why this one takes a bit longer than the others, many of the others. 1 for 5 bonus issue, BI bonus issue. So I suppose that must be 750 divided by 5 multiplied by 1, which is 150,000. So 750,000 odds divided by 5 multiplied by 1, 150,000 multiplied, of course, by 25 cents. And that answer over here is 37.5. And the 37.5, of course, is financed out of the share premium account. Now that's very, very important indeed. This comes from there. All right, so if I move on a little bit, the grand total therefore becomes 225 and 250. That should be at the year end. 31st December 2005 should be 225 and 250. Is that actually in our... Yes, it is. Point number B, option B. So I'll just run through that again because it's based on a few principles from general knowledge, company law. We haven't done question company law yet because that's F4, but I suppose you could argue that this is just general common sense. So we've got ordinary share capital given to us in the question at the end of last year, the capital structure, 500,000 shares of 25 cents each. So that's 125,000 and 100,000 actually in dollars, as you can see, to start with. No problem. The rights issue is said to be for, during the year, of course, 1 for every 2 held. So clearly if I have 125 and 100 and you've got 1 for 2, you just bring in 250,000 more shares. And because 25 cents is the par value, the leftover bit, of course, is 75 cents. So 250 times 25 cents is 62.5. 3 times that, of course, 187.5. And so as you add up the whole thing, you find yourself with a running total of 750,000 shares. But of course, 1 for 5 is a bonus issue. So you divide by 5, multiply by 1, and don't forget it's always the par value. So bonus issues are always at full value. That is to say, par value, at par value, nominal value. You don't go for any excess value. It's just the nominal value. but it isn't below that. It's always at nominal value. So that 37.5 has got to be financed out of the share premium account. In time to come, you'll find that to be Section 610 of the Companies Act 2006 if you are studying F4, the Companies Act, UK stream of UK Companies Act. So there you are. The 37.5 comes out of the share premium and into the share capital, Section 610 Companies Act 2006. That's where the authority comes from. Alternatively, you could just think of it as just common sense. If there's a bonus issue, it can't be financed by bank. In other words, you don't debit bank and credit share capital. Bonus issue, of course, you don't debit bank, you debit share premium. You're using the share premium account instead of bank so as to credit the share capital account. So it's very, very easy indeed. And indeed, we have a part B there to be able to tick, which is always a comforting thing to see that there is an option that you can comfortably tick. There you are, point number B. Right, let's march on to the next challenge. Relentless, this is. Number 27. The inventory value for the financial statements of Q for the year ended 31st of May 2006 was based on an inventory count on the 4th of June, 4 days later, which gave a total inventory value of 836,200. Maybe at the 31st of May, staff were not available. So what do? You count it 4 days later. Between the 31st of May and the 4th of June, the following transactions took place. Purchases of goods, 8,600. Sales of goods, profit margin, 30% on sales. Careful. Goods returned by Q to supplier, 700. So how do I cope with that? Just follow a standard procedure. Opening plus purchases minus sales, of course, gives you the amount counted. So what I'm going to do is to just adapt my usual cost of sales approach, because it isn't quite cost of sales. I've got to be a little bit adaptable here. So let's have a look. Use some imagination as we face this question. So question number 27 then. What adjusted figure should be included in the financial statements for inventories? So clearly I can't count the inventory on the 4th of June and bring that into the balance sheet, the SFP, as at the 31st of May. That's patently wrong. So what do? I just reverse what happened during the 4 days. You follow that? So if we say the inventory needed is the opening at 31st of May 2006, that is an unknown figure. An unknown figure. Plus purchases, which is given as 86, minus sales that you sold of 98. Now, how do I get the 98? I'm going to bring in the 14,000 and take 70% of that. 17 fours are 98. Alternatively, what you could do is to take your 14,000 and minus from that 30%, which is, of course, 4,200. So what's 14,000 minus 4,200? The answer, of course, is 98. So if you have an opening inventory and then you buy something and then you have a sale of whatever that is, 9,800, and then there are some goods returned, be careful of that. Goods returned by Q to the supplier. So that's almost like a purchase being returned. Purchase returns outwards, away from inventory. Purchase returns outwards is said to be 700. So that is like a deduction from the purchases. And so what's counted on the 4th of June 2006 is a figure of 836,200. So that's what's counted at that date. What I need to do with your help is to work backwards to work out what that figure might be as at the start. So perhaps if I do a little arrow like this, it might give us a feel for where we're going. And so if it's 836,200 there, if I'm working backwards, I suppose what I would do is to add the 700 and the 98. So let's actually try that out. I have my calculator here, as you will have in the exam. Let's pick up our 836,200. And instead of deducting 700, suppose I add it. And then instead of deducting 98, suppose I add it. And instead of adding 86, suppose I minus it. The figure that turns up is 838.1, and that indeed is the answer. If you're in any doubt, you should work downwards again to make sure it's all adding up now. 838.1. So if you add 86 to that, it's about 844. Take away about 10,000 or so. Just over. So it comes out to 836.2. Make sure that that is right. 838.1 is obviously our answer. So let's go back and see if we can tick it off. 830. Be careful, the figures are quite similar. I would say A is the answer in this particular case. So it seems like if you have a nice little pathway, opening plus purchases minus any sales. The purchase returns, by the way, is the 700 operates as a reduction of the to the 8,600. That's why it's more conceptually linked to the purchases than to the sales. So do be careful. But I suppose what one could argue is you have some inventory, you buy some more in, 8.6, you sell out, 9.8, and in that sense the goods returns are also being sold out, returns outwards. So it's either coming in or outwards. For that reason I've put the two bracketed items next to each other. Conceptually they're more similar, I suppose one could say, in terms of direction. Though another way of looking at it is in terms of accountancy, there is probably closer to the purchases. So it depends on how you want to approach it. But the fact of the matter remains is that the purchases is added, the sales is deducted, and the purchase returns outwards, is also deducted. And so you work backwards and you come up with your answer. So quite a big challenge, that little question. But quite often I see that even at other levels, F7 in particular, where you have a big final accounts exercise and you have one of those as one of your first adjustments to the trial balance. So all examiners like this kind of point, like in point number 27. However, our task is to somehow move on to question number 28 and continue to do fight with this exercise. Question number 28 coming up then. In preparing a company's bank reconciliation statement, the following items are causing the difference. I see. So they are causing the difference between the cash book and the bank statement balance. Which of these items will require an entry in the cash book? Notice nothing needs to balance in that sense because they haven't given you the other balances. You see, the other company's balance, or the other side of the argument. So which items will require entry in the cash book? Most definitely the bank charges, on the grounds that the bank did it, and let us know about it afterwards, the exact figures, some charge that the bank made, for whatever reason. Error by bank, so that's the bank's problem, nothing to do with the cash book. The lodgements not credited, outstanding checks, all this goes directly to the bank statement, to the bank reconciliation statement. But direct debits, yes, we come to know about it later, the exact figure, so we certainly record that. Checked, paid in by the company and dishonored, I see. So in the cash book, we thought the money was good. We then sent it to the bank, the check that we received from our customer, and the bank had a problem with it, and the bank lets us know about it later. So those three items we need to be told about these three items by the bank, and so the cashier in the cash book then changes it. So those three, I think, would be the answer. Items 1, 5, and 6. Is there such a thing? Yes, there is, B. And so you got your couple of marks. That required thinking rather than calculating. However, the next one is the other way around, where you've got to do some calculations, some rather serious-looking calculations. So can you read that, please? Stop the tape now as you begin to read that. So, at the 29th of, I beg your pardon, question number 29, at the 31st of December 2005, the following require inclusion in a company's financial statements. I'm going to underline the word require. It tells me that I have to do something with these. That's a company. On the 1st of January 2005, the company made a loan of $12,000 to an employee payable on the 1st of January 2006. Repayable. So that's going to be repaid early in the new year. So it says there towards the end, for these items, what total figure should appear in the company's balance sheet, SFP, as at the end of December 2005? Be careful. So let's go back and read point number 1. On the 1st of January 2005, the company made a loan of $12,000 to an employee. So underline to an employee, I see. Repayable on the 1st of January 2006. Charging interest of 2% per annum. On the due date, she repaid the loan, the employee repaid the loan and paid the whole of the interest due on the loan to that date. So I'm thinking on the lines of 2% multiplied by 12,000, which is obviously 240, plus the 12,000, plus the 240 plus the 12,000 she pays us, so the company's happy with that. The company has paid insurance of $9,000 in 2005, covering the year ended August 2006. So I suppose 8 months of that falls into the new year. So about 6,000 is prepaid. I might write that out a bit more clearly in a minute. Prepaid insurance. In January 2006, is it just after the year end, the company received rent from a tenant, $4,000 covering the 6 months of December. So that's fine. So that has to come in. So there's a current asset receivable at the year end December of indeed 4,000. So says questions. For these items, what total figure should be included in the company's balance sheet? Thinking about 12,240 being the receivable from the employee as at the year end, the figure of 6,000 is a prepaid insurance, and the rent receivable is 4,000. So I think all three of them appear to be assets, current assets. So let's write something out maybe a little bit more formally than that as we face this little exercise. Quite straightforward, really. Here we are. Question number 29. I think it looks worse than it is. Point 1 is 2%, 12,240 plus 12 equals 12,240. And that is something receivable in the next year, indeed in the next day or so. There's a prepaid insurance, so this is the employee loan. Then you have the prepaid insurance, which I believe is 8 months multiplied by 9,000, careful, is that about 2/3? So that's 6,000. So that is the prepaid insurance, no problem, which is like an asset, I suppose, current asset. And then the last one is a company received rent from a tenant just in the new year, but for the 6 months gone by. So I suppose that's just a casual 4,000, which I can describe as a rent receivable. Anything that suits you, any style of presentation. I've gone for quite a quick presentation there. So if you grab hold of all three of these, 22,240, because of the dates, is my current assets. Is that correct? Yes, indeed, it is part B. So let's break back and have a look at that. So stop the tape for a second, just as you consider the 12,000 and so on there. Just write that a bit more neatly. It's better. And that is meant to be a 0, beg your pardon. And so on. Let's go back and consider putting that into our question paper or our computer screen. Point number B is what I would like to tick. How should a contingent liability be included in a company's financial statements? Next question. If the likelihood of a transfer of economic benefits is remote. Remote means you don't disclose it or provide for it. In other words, therefore, basically ignored. And so that's your remote answer, answer to remote. So where the chances are very, very slim indeed, don't bother with it. Ignore it. No disclosure or provision is required. That was quite easy, wasn't it? One of the common sense points, or perhaps even a proper accounting standard if you wish. What else do we have? The question number 31, moving on. Which of the following material items after the balance sheet date, SFB date, also known as IAS 10 events after the balance sheet date, and before the financial statements are approved, are adjusting events? So again, we have to just use our common sense. A valuation of property providing evidence of impairment in value at the balance sheet. Impairment means loss in value. Lost value. Impairment is a loss, something becoming impaired. If I hit my finger against the side of the machine by mistake, it upsets the machine, of course, but it, to some extent, for a little while, my finger slightly impaired. I can't hold my pen, quite struggling a little bit, because I accidentally, I lost, in this case, a bit of grip, but I've just somehow become a bit affected in a negative sense. So, evaluation of property, providing evidence as at balance sheet date, absolutely fine, before the accounts are signed, of course. Sale of inventory held at the balance sheet date for less than cost. Basically, the NRV, net realizable value, is lower than cost. And that's absolutely fine. Discovery of fraud or error affecting the financial statements. So the year end is there. A little while later, you sign the accounts. The directors sign the accounts. Obviously, during those few weeks, you come to know about some fraud as at the year end. Clearly, you must affect it. You must, because the discovery of the fraud, which is the event after the balance sheet date, SFP date, throws light on the true situation as at the year end. And so you must affect it. It's called an adjusting event. The insolvency of a customer, this is just like a bad debt, isn't it? So for that reason, I'm going to give that one a tick as well. So that's 1, 2, 3, 4. Is there such a thing here? Indeed there is, point A. Okay, so how do you cope with something like that? All I can say is use your imagination. Just read it and say, wow, it's just, you read it, valuation of property, the value goes up. Yep, that's fine. Sale of an inventory, NRV is lower than cost, you take the lower of cost and NRV, yes, that's fine. Fraud, well, you come across it later, that's fine. And then the insolvency of a customer, the debtor, well, what can you do? As at the year end, there is a good debtor, a good receivable. A few weeks later, that receivable goes into liquidation. You haven't signed your accounts yet. Do you expect to receive any money from that person? Of course not. He or she's gone into liquidation. That company's gone into liquidation. You see? So they owe you $10,000. You think it's good, as at the year end. Just as you're finalizing the accounts, you come to know about the fact that they've gone into liquidation. What do? Just write it off, bad debt. It's definitely an adjusting event. Adjusting simply means it throws light on the true situation as at the year end. Non-adjusting is where it doesn't do that. So be careful of those points. Where he says it clarifies the situation at the year end, then you bring it in. Otherwise you don't. It's as simple as that. It's such a simple exercise. Be confident you cannot fail this exam. Okay? We must go for 70s and more. Now, question number 32, by contrast, is a slightly difficult point. Let me show you what it says. Alpha received a statement of account from a supplier called Beta, showing a balance to be paid of 8950. So, this is from a supplier Beta, so I think this is Beta's books. Beta's books. Alpha's payables ledger account for Beta shows due to Beta. This is in Alpha's books. So 4,000 etc. is Alpha's books. So there's a big discrepancy there. Investigation reveals the following. Cash paid to Beta has not been allowed for by Beta of 4080. So, Beta's books says 8,950 is due from Alpha. This is in Beta's books. But of course, Beta hasn't quite allowed for the 4080. Next point, Alpha's ledger account has not been adjusted for 40 of cash discount allowed by Beta. So what do? You just allow for it, I suppose. Not been adjusted for 40 of cash discount allowed by Beta. So in Alpha's books, the 40 disallowed. Sneaky little word. I kept reading that as allowed. So disallowed actually means it's an add. So they've changed their minds and disallowed it. So this figure here is 4180. This figure here, of course, is 4870. 4180, 4870. Is that discrepancy, is that difference something like 690? So I reckon the difference between those two can be linked up to point number A. I wonder if I can just be a little bit more careful in my explanation here. It's not that obvious, so I might just take the liberty of spending a few more minutes getting some more deepening your understanding. Let me try that. So we're moving on in our little working sheet. Let me just do it here. Little working sheet, question number 32. So we've got here B's books, A's books, 8950, and over here we've got 4140. This was a minus 4080. 4870. This one was a plus because the word disallowed, easily misread. and this is 4180. And that difference, that discrepancy, is of the order of 690. So how do I deal with that? I suppose it says alpha's payables. So alpha has to pay this to suppliers. For beta shows a balance due to beta of 4180. So basically, debit discount received 40, credit payable is what needs to be done. You see, because discount received from the person we owe money to, if they say, don't worry about it, take a discount, and then they change their minds for whatever reason, either there's some problem with the quality of the goods or whatever it might be, or some dispute about whether they actually did say that. So as far as we're concerned, the discount received, which is normally a credit, I need to cancel it by debiting it. See, so that's the sort of idea we're talking about. Whereas here we could say debit cash or bank and credit receivable. And here it is 4080 and 4080, and that's your little cash receivable. So these are the items that I've chosen to select to show upstairs. So this is this one. Whereas this 4080 is this one, of course. And so if you look at the difference, it's still the discrepancy. Interesting that they haven't allowed you to actually reconcile it. That would have been more satisfying, but maybe that couldn't have been accommodated within 2 marks. So the examiner is being very, very fair. And just as you're beginning to feel a bit thrown by the depth of that question, though I must say the journal entries I've used towards the end are completely optional, so don't worry about that. But in case you are beginning to worry about how much time this is taking, and that indeed is part A, she then gives you an incredibly quick question to pick up a few marks in terms, minutes in terms of time usage and confidence. A business entity concept requires that a business is treated as being separate from its owners. Is that true or false? And the answer quite definitely is that it is true. It is separate from its owners. We're doing partnerships recently. We were doing limited company accounts, sole traders. The two are meant to be separate in terms of the accounts anyway. And so we press on. Theta, question number 34, prepares its financial statements for the year to 30th of April each year. The company pays rent for its premises quarterly in advance. I see, in advance. Right, careful. On the 1st of January, 1st April, etc. The annual rent was $84,000 per annum until the 30th of June 2005. I see, until that date. It was increased from that date to $96,000 per annum. Careful. So I reckon the 2 months, you see the year end is April, so April's gone, May and June, so May and June 2005 must have been 2/12 of 84, so I'll call that 14, plus of course you've got July to December, July, August, September, October, November, December, January, February, March, April. So actually that's 10 months. 10/12 multiplied by 96 is obviously 80. If you grab hold of both of those things, 94 should be the expense. So certainly this one looks pretty good, 94. And the prepayment, I suppose, is another matter altogether. If 96 has been paid, quarterly in advance, so let's say on the 1st of January, you've paid for January, February, March, April. Then on the 1st of April, you've paid for the month of April, May, June, I suppose 2/12 of 96 is prepaid. So 1/6 looks to be $16. So I'm going to change my figure now. This time it's going to be, this one's a lot better. Now we're talking. So 16 is the prepaid. Now the months that we're dealing with here, this is the months of May and June 2006. Whereas over here you've got July, of course, July till for 10 months to 30th of April. So you've got July, August, September, October, November, December, January, February, March, April. Yes, feels like 10 months, 5 and 5, 10 months. So there you are, adding all that up. 14 plus 80 is 94, and 16, of course, is a prepaid. Do be careful of that. It's easy to go for the wrong combination. 16 is the answer. So most definitely part D is where I should go with those numbers. And so we move on to point number 35, question number 35, as we continue to fight our way through this exercise. Not too bad, I hope you can see. Question number 35 next then. Which of the following items could appear in a company's cash flow statement? In a company's cash flow, be careful. Surplus and revaluation of non-current assets, no way, because it's non-cash. Though you might need to bring that into account, take that into account when you're trying to work out the purchases for the year, when you're doing your little workings. But on the face of it, the revaluation, no way. It's non-cash. It's simply a change in value. It isn't cash coming in. Proceeds of issue of shares, that looks very comfortably yes. Proceeds, inflow, money coming in. In fact, the question says cash flow statement in or out. So in this case, of course, I'm going to give a tick to proceeds because whatever's issued at, money comes into the business. So it's definitely a cash flow item. Proposed dividend, nope. It's only proposed, hasn't been paid yet. So not paid yet, therefore not a cash outflow. Not a cash outflow. So just neaten that up a bit. Propose is the bad word there. And so, what else do we have? Dividends received. Yes, no problem. So there's 2 and 4 available to us, point D. That didn't take long. If you really understand your cash flow. Revaluation, no way. Proposed dividend, no way. What's left? Proceeds, money coming in dividends received, obviously money coming in as well. So 2 and 4 looks absolutely comfortable. You should like cash flows. It's one of the great topics of the syllabus. What is the role of the International Financial Reporting Interpretation Committee? Now, it's quite advanced, quite a lot of general knowledge required there. The role of creating a set of global standards is, of course, the work of the Accounting Standards Board. So there's only one left. To issue guidance on the application of international, of course, that's absolutely fine. So I'm going to go for B. A is completely wrong. That didn't take long. So read some of these bits on accounting standards and concepts and things. Right, let's read on. Q's trial balance failed to agree and a suspense account was set up, as you'd imagine. Q does not keep receivables and payables control accounts. The following were found in Q's accounting records, the following errors. In recording an issue of shares at par, cash received at $333,000 was credited to the ordinary share capital account as $330,000. So I suppose the question says, which of the errors will require an entry to the suspense account to correct them? So where you have a difference in the journal entry between debits and credits, then of course the suspense is involved. So I'm going to definitely tick off point number 1. Notice there is no balance on the suspense account for me to get rid of. So I don't know what the original balance is, so I haven't got a focus. On the other hand, I can tell whether, if the double entry doesn't agree, slightly out, then the suspense comes in temporarily. Remember, suspense is just a temporary suspension before the right answer is worked out. So rather than bothering with a big journal entry, just say to yourself, well, the journal entry doesn't balance, so the suspense must have been involved. That's it, done. Don't have to worry about the numbers. Cash $2,800 paid for plant repairs, which is a debit, was correctly accounted for in the cash book, but was credited to the plant asset account. So if you've gone and credited something to the... so obviously your suspense account is needed to cancel that 2,800. So most definitely the answer is yes. Could well need to be doubled up there to get rid of it. The petty cash book of 500 has been omitted from the trial balance. So obviously your debit side of your trial balance is understated by 500. So what did you do? You brought in the suspense account as a substitute to make sure it balances. Remember, when you're doing suspense accounts, assume that everything else is correct except this item in front of you. Only then can you see it in the correct focus. Okay, so there you are. Most definitely yes, petty cash. A check for $78,400 paid for the purchase of a motor car was debited to the motor vehicles account as $87,400. So is that plus $9,000? So you've paid a check for $78,000, but it's gone to the motor vehicles account as $87,000. So obviously the debit side to the motor vehicles account has been overstated by 9. How do you make the books balance? Put something on the credit side called suspense. So most definitely the suspense is involved. So I'm going to go for something like 1, 2, 3, and 4. The nice thing about this exercise is even if you try to do the numbers, getting all into a tangle with regard to how much the suspense account, at the end of it all, there's nothing to prove that you're right, because the opening suspense hasn't been given to you. So it's a difficult one, really, to get too involved with. It's a pity. I would have liked to have done a bit more, but it seems a bit foolish to do too much work and then suddenly realize actually that it wasn't necessary. The numbers are not needed. Always look at the question. You see the message there? Look at the question. The numbers are not needed. A great relief, of course, makes life a lot easier. But the simple truth is, if that's only 2 marks, and even if it takes twice as long as some of these questions are taking, because there's something else that might be easier to balance the books, if it's much bigger even, it still takes much longer by the time you do a full-blown suspense and so on. So where you can avoid the numbers by reading the question, just stick to that. Don't waste time. Okay? You mustn't answer something that's not needed, certainly. All right, let's march on to, say, question number 38, perhaps. Mountain sells goods on credit to Hill. Hill receives a 10% trade discount from Mountain and a further 5% settlement discount if goods are paid within 14 days. Hill bought goods with a list price of $200,000 from Mountain. Sales tax is 17.5%. Calculate, assuming 5% is claimed, of course, how you do this kind of thing. What amount should be included in Mountain's receivables ledger for this transaction? So I suppose what I should be doing is starting with 200,000, taking away 10%, so that's about 180, adding 17.5% to that, sales tax, and assuming, of course, that the 5% discount for quick payment, settlement discount, is actually claimed. So that's how I'm going to go about doing this exercise. So it's interesting, a small little peculiarity with regard to sales tax. So stop the tape now as you reread the question number 38. So here we are, question number 38. The list price is 200. I might keep some zeros going because some of those numbers look quite detailed. Less the trade discount, which is 10%, which is clearly 20, or 180. Now, careful. The 180, I need to add sales tax to at the rate of 17.5%, or 15, or whatever percent the value-added tax might be. In this case, they call it sales tax. Absolutely fine. Now, there's a small little rule which says you've got to assume, when you're trying to work out the sales tax, that the discount for quick payment will be claimed. So Mountain, that's you, is doing the selling. So sales tax sounds about right. Paid within 14 days. So suppose I take hold of my 180, take 95% of it. 5% is the discount. So that's discounting it by taking 95%. And then that answer, I'll multiply by 0.175 or 17.5% if you prefer. Putting that into a calculator, I believe that answers 29,925. Which when added to the 180 is 209,925. At first I thought I'd round it off, and I suddenly saw that the requirements expect me to keep it full. Don't round off. So the answer here, I would say, is item number D. So I think of all of that, this is the most dangerous point, isn't it? The fact that the discount is, or the discounted price, assuming that the 14-day discount is claimed, the discount price is what the tax is based on. Be careful of that. 209,925. So it's quite a dangerous point. Just be careful. This is an ACCA pilot paper, and that means it's an indication as to the future. So be very careful with that. All right, let's go back and see if we can pick up a few more points. Point number 38, I'm going to go for the last mentioned. Point number D, Mountain's receivables ledger. So we are selling on credit and charging them some tax. But that tax that we charge them is based on the fact that they will be claiming the discount, or at least we must assume that. All right, so that's quite an important point there. And so we move along nicely to the next challenge, number 39. A computerized accounting system. Notice how fair this paper is, as the real exam will be. We had to struggle through, no doubt, point number 38, especially the bit about the VAT, or the sales tax. And then you come to something like point number 39, which is ridiculously easy for 1 mark. A computerized accounting system operates using the principle of double-entry accounting. Of course it does. So that's true. Absolutely fine. How can it be false? How can you have a one-sided entry system? It's got to be. It's got to be the total. You see? So there you are. We've done 39 questions. Can I invite you at this point to have a look back at those questions you've just been doing? The most interesting one, I think, apart from the 5% discount, claiming that they will take advantage of it, quite apart from that, the other one that I thought was quite interesting was question number 37, where I was initially tempted, as I'm sure you were as well, to do the suspense account because we've got our suspense skills all worked out, debit, credit, get the trial balance fixed up. But then you look back and say to yourself, well, it wasn't really required, so what's the point in doing it, you see? So you've got to keep your discernment, keep your nerve, and say, what am I being asked about here? Is it just something like which of the errors should go to the suspense account, rather than what's the figure, balance it? Well, that's a different league of question altogether. So it's nice to do some of the numbers if you wish, but when in the exam, certainly, I would be inclined to just read the instructions and stick to that. Don't go beyond, because that'd be a terrible waste of time and marks. Okay, so the other message that's coming through, I suppose, is there's a lovely mix up to question 39, certainly, of numbers and discussion, or just words, and between seriously challenging questions and obvious ones. So never get concerned if you find that the 2 marks is taking much more than what you'd expect to spend on those 2 marks, because the next one may be a 1-mark question which you can do in 10 seconds. So keep your nerve, keep a rough idea as to the time. For example, if you are doing it as if in the exam, clearly by about the 25th question I should be somewhere near the 1-hour mark and vice versa, because I've got to do 50 questions altogether. Okay, so that's the way we're going to do it. But of course, in class, now with my session with you, I'm taking the liberty of taking a lot of time to explain everything I possibly can, because I want you to pass. I want you to get that wonderful mark that you deserve. Thank you.